So there is a fella, Dennis Gartman. Who is he? I'm going to go to the Gartmanletter.com about page and tell you who he is. So many of you already know the name. Mr. Gartman has been publishing his daily commentary, the Gartman Letter, since 1987. Over the years, he has also conducted numerous presentations and courses on issues relating to the capital markets and derivatives for various brokerage firms, central banks, and U.S. government entities. In recent years, Mr. Gartman has been a frequent guest on leading financial television and radio networks. What does Mr. Gartman have to say according to Zero Hedge? Gartman stakes his reputation that the bull market has come to an end. Well, of course, speaking about the overall stock markets. If the algos were waiting for just one catalyst to unleash the buy everything, sell VIX program, they may have gotten it moments ago when following a global rout across markets on yet another day of North Korean nuclear war concerns. Dennis Gartman, staking his reputation, said that he is fearful, very, that this wondrous bull market that began in the spring of 2009 has come to an end, and we do not make this statement lightly, for we know the damage that can be done to an already damaged reputation if this statement proves to be wrong. Judging by the spike in futures after today's fifth consecutive miss in CPI, which paradoxically has now pushed the dollar higher, Gartman's reputation suddenly appears in peril. His key thoughts in the excerpt below. There are two questions facing us this morning regarding investment in equities. Firstly, will the machines, the algorithmic buyers, trained only to buy weakness, step to the fore once again and buy equities with abandon? We must remember that the machines have a very limited memory. They have no memory of decades past of the protracted bear markets. Instead, their algorithms tell them to simply buy weakness, and this clearly is weakness. So shall they? That is the question. Secondly, we wonder if the supposed support for the market here in the U.S. at or near 2,435 in the nearby S&P futures and in the spot will hold. For as the chart included, that doesn't show it here, would seem to suggest that support absolutely must hold. And as we write this, it is, and as the day progresses, it must. We have our very serious doubts, however, and those doubts are raised for a number of very real and very serious reasons, not the least of which is that some of the truly best and brightest investors of our age are retreating or have already retreated to the sidelines, fearing the arrival of at least a material damaging correction of some 7 to 10%, or perhaps even the onslaught of a true bear market. Paul Singer, in our eyes, one of the 5 best investors of the age of Elliott Management, has said that he is prepared for all hell to break loose. Bill Gross, perhaps the preeminent bond market analyst, trader, investor of the age, has gone on record as stating only just recently that the risks of equity ownership are as high as they were in 2008, and that at this point, when buying weakness, instead of buying low and selling high, you're buying high and crossing your fingers. And then there's the always quotable, ingenious Mr. Howard Marks of Oak Tree Capital, who's gone on record to suggest that the perpetual motion machine that everyone has come to believe the stock market to be to the upside has ground to a halt. Finally, we wrote yesterday about the rare nature of the unanimity of movement in stocks around the world, and said the fact that there is unanimity of weakness, it's important to us, for this is a rather rare event. Indeed, history shows that unanimity of market movements such as this happen at beginnings of and or the endings of protracted trends. Thus, bull markets end with either a universal day higher, or to see it end with a day such as the current day, when all 10 markets turn lower. In other words, we do not take this sort of unanimity of direction lightly, but rather we pay it very serious heed. We are indeed fearful, very, that this wondrous bull market that began in the spring of 2009 has come to an end, and we do not make this statement lightly, for we know the damage that can be done to an already damaged reputation if this statement proves to be wrong. But the monetary authorities who've sponsored this bull market with their massive injections of money born out of the ether have begun the process of either standing down from that monetary expansionism or have at the very least chosen to slow down the process, either of which shall be deleterious of or to equity. And let's not also forget, Federal Reserve, we've got a $4.5 trillion balance sheet we need to unwind, and we plan on unwinding it here shortly. And as I said before, how do they really truly plan on doing that? Who's going to buy that? Where's it going to go? How do they just unwind it? You know, how do you unwind a $4.5 trillion debt on your books? You know, it's the Federal Reserve. It doesn't just go bankrupt, right? Well, the bank's going to buy this crap? You've been buying from the banks this whole time. You've been buying their shares of their companies, the Googles, the Yahoos, the Amazons, whoever. These banks can't afford to buy this crap back from you. How do they plan on unwinding this? At all the wrong timing, too, huh? Take care.